If I told you a company just reported a $53 million net loss on a measly $3 million in revenue, you'd probably call it a sinking ship and swipe to the next ticker without a second thought. You'd assume the story was over before it even began. But what if I told you that while the entire retail crowd was staring at those ugly losses, the most powerful asset managers on the planet, Vanguard, State Street, and BlackRock, were quietly backing up the truck, expanding their positions by thousands of percent in just a matter of months? That's the puzzle we're cracking today. Why are institutions buying millions of shares of Datavault AI, ticker DVLT, when the numbers look like a disaster on paper? This is the strange, high-stakes contradiction we're going to unpack piece by piece. Today is July 3rd, 2026, and we're looking at a company that is either the greatest moonshot opportunity of the decade or a technicality-driven collapse waiting to happen by August. If deep dive stock breakdowns like this are your thing, do me a quick favor and hit that subscribe button. It genuinely helps the channel grow, and it's completely free. Now, let's get into it. To understand why the smart money is betting on a company that looks like it's bleeding out, we first have to look at the massive infrastructure they're actually building behind the scenes. At its core, Datavault isn't just another company slapping the letters A, an I onto its name to ride a trend. They are positioning themselves as the physical backbone for the next generation of the internet. We're talking about a high-growth, high-risk infrastructure play that bridges three of the most explosive sectors in all of technology: artificial intelligence, edge computing, and real-world asset tokenization. They're trying to answer a very specific and very valuable question. Where does all this data actually live? And how do we put a real value on the physical resources that power it? And this isn't just wishful speculation. Wall Street analysts are looking at this exact setup and pinning a consensus price target of $3 on the stock. From where DVLT sits today at around 39 cents, that represents a staggering 1,000% upside. But before you get too excited and start dreaming about that kind of return, understand this. There is a clock ticking loudly in the background, and it could wipe absolutely everything out. Now that sounds like a wild gamble until you realize the sheer scale of the partnerships they just put on the table. The biggest catalyst on the board right now is something called SMAP, the Strategic Materials Acquisition Platform. Datavault recently announced a proposed partnership with Patriot Strategic Metals to launch a digital infrastructure for the critical minerals sector. And this is enormous. We're talking about a phase 1 program valued at $700 million. Now here's the clever part. Datavault isn't the one out there digging minerals out of the ground. They're providing the brains of the operation. They are slated to receive roughly $62 million just for the technology integration and real-world asset services alone. Think about it. In a world completely obsessed with supply chain security for electric vehicle batteries and advanced electronics, Datavault is trying to become the invisible digital layer that tracks and tokenizes those raw materials. That's a powerful position to hold. But the minerals play is only one half of this physical infrastructure story. So what about the hardware? While the minerals platform handles the what, their GPU fleet handles the how. Datavault is currently rolling out a 48,000 GPU fleet across 1,000 urban micro-edge sites right here in the United States. For anyone who isn't deep into the tech world, edge computing simply means putting the processing power physically closer to the user to slash lag and boost speed. And Datavault estimates the capacity value of this fleet somewhere between $1.44 billion and $1.92 billion. At the very same time, their YSA Technologies division is making aggressive moves over in China, integrating wireless audio into high-end home theater systems. So while nobody was watching, this company was quietly building a global footprint of hardware. But that raises an obvious question, doesn't it? You might be sitting there asking, if they have billions of dollars in assets in these massive partnerships, why on earth is the stock price so low? Well, that brings us to the one thing that historically moves markets more than any press release ever could: institutional accumulation. This is the pattern interrupt that should make every single investor stop scrolling and pay attention. Between late 2025 and early 2026, we witnessed an unprecedented influx from the institutional giants. Vanguard went from holding 393,000 shares all the way up to 11.8 million. State Street jumped from 335,000 to a full 10 million. And BlackRock tripled their position to 4.1 million shares. Let that sink in for a second. These are not meme stock day traders chasing a hot tip on social media. These are the largest and most sophisticated asset managers on the entire planet. They are not buying because of a viral tweet. They are buying because they see a valuation disconnect that is frankly becoming impossible to ignore. And here's what makes it even more compelling. It's not just the outside institutions. The people running the company are putting their own personal wealth on the line, too. On April 20th, 6 company directors were each granted 250,000 shares. Now, this is a crucial detail that most casual investors will completely overlook. Their compensation is now directly tied to a share price recovery. When the board's personal net worth is bolted to the stock, climbing back above $1, you can absolutely bet their priorities are perfectly aligned with yours. They're no longer just employees collecting a paycheck. They are fellow shareholders fighting tooth and nail for a turnaround. But here's exactly where the story starts to get much more complicated. We have to talk about what I call the chasm. Despite all those glittering billion-dollar asset estimates, the current financial reality is genuinely grim. In the first quarter of this year, Datavault generated just $3.4 million in revenue while losing a jaw-dropping $53 million. That is a massive operational gap, and there's no sugarcoating it. Management is targeting $200 million in revenue for the full year of 2026. But to get anywhere near that number, they have to convert those proposed minerals and GPU deals into active revenue-generating status immediately. There is absolutely zero room for error here. And when you're burning through cash at that kind of rate, you need a serious survival strategy. So what's their move? To keep the lights on while they wait for those $700 million deals to actually close, Datavault is selling its own digital gold. They've entered into a binding agreement to sell 837 Bitcoin for $50 million. And crucially, they expect $30 million of that amount up front. This is a calculated move to secure a short-term runway. Think of it as a bridge loan they're giving to themselves, specifically designed to stop the bleeding while they wait for that SMAP revenue to finally kick in. It's a bold play, no question. But it also tells you something important. They are willing to liquidate core assets to protect the future of the platform. That's conviction. But even with $50 million in fresh cash, they're still staring down a red line in the sand that they simply cannot move. This is the single biggest risk factor in the entire thesis, so listen closely. Because the stock has been trading below $1, Nasdaq has issued a deficiency notice. Datavault has until August 24th, 2026, to push the stock price back above $1 for 10 consecutive trading days. If they fail to do that, they could be delisted down to the over-the-counter markets, which almost always leads to a brutal drop in liquidity and a mass exodus of institutional support. And to make matters worse, compounding this whole situation, their auditor, BPM LLP, recently resigned. Now, while the company claims there were no disagreements whatsoever, let's be real. An auditor walking out the door right before a delisting deadline is a massive red flag that we simply cannot ignore. So we're left with a genuinely binary outcome. Either they hit $1 and the whole thing explodes higher, or they fail and it crashes. So what does the actual valuation tell us? If you believe management can successfully bridge that chasm, the reward here is genuinely life-changing. At a price-to-sales ratio of 6.9 times, DVLT is technically undervalued when you compare it to the broader semiconductor industry. Analysts are holding a consensus target of $3, and some community fair value estimates climb as high as $4.20. We're talking about a potential 10 times return if they simply manage to reach the industry average. The upside is clearly there for the taking, but the market is currently pricing in a very high probability of failure. And whenever there is this much doubt swirling around a stock, the short sellers are never far behind. Right now, the shorties are out in full force. Short interest is sitting at 19.44% of the float, with over 104 million shares bet directly against this company. But here's the kicker that gets really interesting. The days to cover metric is sitting at 3.81, and the borrow fees are running over 10%. In plain English, that means it's getting expensive and painful for the shorts to keep holding their positions. So imagine this scenario. If Datavault drops one single piece of major news, like the final closure of that Bitcoin sale or a definitive signed SMAP agreement, we could see a violent short squeeze as all 104 million of those shares scramble to cover at the same time. That's the kind of setup that can move fast. So how do we actually trade something like this? Let's break down the levels. For the upcoming week of July 6th, I'm personally expecting a trading range between 32 cents and 51 cents. We have immediate resistance sitting right at 41 cents. If the stock can break through that pivot point, the next major stop on the map is 51 cents. And beyond that, the ultimate goal is the $1.30 to $1.40 range, which is exactly what would finally clear that Nasdaq compliance hurdle. On the downside, we've got a floor established at 32 cents. If we break below that level, the next hard line of support is 25 cents. Make no mistake, this is a battleground stock, and the charts show it perfectly. So depending on your personal risk tolerance, there are really two ways to play this. If you're a short-term momentum trader, your trigger is a clean break above 42 cents on heavy volume. You're trading the raw volatility of the news cycle, and you keep a hard stop loss set at 32 cents to protect yourself. But if you're a long-term speculator, you're looking to accumulate somewhere in the 35 to 39 cent zone. Your target isn't a quick 10 or 20% flip. You're holding for that potential 10 times return up to $3, entirely contingent on them hitting that $200 million revenue goal. At the end of the day, it all comes down to a simple balance of risk versus reward. So let's be completely objective about it. The bull case here is genuinely strong. You have a $1.4 billion GPU asset base, a $700 million minerals partnership, and the powerful backing of Vanguard and BlackRock. That is a seriously high pedigree foundation to build on. However, the bear case is equally heavy. A $53 million loss, a delisting deadline that's less than 2 months away, and an auditor who just walked out the door. This is a truly binary stock. It is likely heading to $3, or it is heading to 0. There is very little middle ground to hide in. So here's my final verdict. DVLT is a highly speculative moonshot play, plain and simple. It belongs only in the high-risk portion of a portfolio, money you can genuinely afford to lose. You buy this only if you truly believe that the minerals platform and the GPU fleet are more than just proposed plans on paper, and that they're about to become real, tangible revenue. Now, before I give you the final word, I have to be crystal clear about something. I am not a financial advisor, and absolutely nothing in this video should be taken as financial advice. This is for educational and entertainment purposes only. Investing in low-priced, speculative stocks like this one carries a very real risk of significant loss, up to and including your entire investment. Always do your own thorough research and consider speaking with a licensed professional before putting a single dollar into any position. With all of that said, the verdict? If you have the stomach for this kind of extreme volatility, the institutional tailwinds, and the massive upside target make this one of the most fascinating setups on the market today. But never forget that August 24th deadline is the ultimate judge, jury, and executioner. So now I want to hear from you. Do you think Datavault pulls off the miracle and breaks above $1 before the deadline? Or do the losses and the auditor resignation drag it down to the OTC graveyard? Drop your prediction in the comments below. I read every single one, and I'm genuinely curious where the community stands on this one. If this breakdown brought you value, smash that like button and make sure you're subscribed so you don't miss the follow-up when this story develops. I'll be watching this one extremely closely. The question is, will you?